Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that many of you have asked about, swing trading. If you were looking for a trading style that's more active than long-term investing, but less intense than day trading, you come to the right place. In this video, I'm going to break down 5 key swing trading strategies that are perfect for beginners. We'll cover everything from identifying trends to setting your stops, so you can start your swing trading journey with confidence. Ready to get started? Let's jump right in. First things first, what exactly is swing trading? Simply put, it is a style where you aim to capture swings in price over a period of a few days to several weeks. Unlike day traders, who close all their positions by the end of the day, swing traders hold on a bit longer to catch bigger market moves. The goal isn't to hit home runs on every trade, but to consistently capture a chunk of the price movement. This approach requires patience and a solid understanding of market trends, which brings us to our very first strategy, trend trading. Trend trading is the bread and butter of swing trading. The old saying, "the trend is your friend," couldn't be more true here. The basic idea is to identify the primary direction a stock is moving either up or down and trade in that same direction. In an uptrend, you'll see a series of higher highs and higher lows. Your goal is to buy during the pullbacks, or the higher lows, and ride the price up to the next higher high. Conversely, in a downtrend, which is marked by lower highs and lower lows, you would look to short the stock during the bounces, or the lower highs. So, how do you spot these trends? Moving averages are a fantastic tool for this. A common technique is to use moving averages, like the 50-day and the 200-day simple moving average, or SMA. When the 50-day SMA crosses above the 200-day SMA, it's known as a golden cross, signaling a potential long-term uptrend. When it crosses below, it's a death cross, signaling a downtrend. As a swing trader, you can use these signals to confirm the overall market direction before you even think about placing a trade. You want to be swimming with the current, not against it. Our second strategy is all about support and resistance. Think of these as invisible floors and ceilings for a stock's price. Support is a price level where a downtrend is expected to pause due to a concentration of demand. In other words, buyers tend to step in around this level, pushing the price back up. Resistance is the opposite. It's a price level where an uptrend is expected to pause due to a concentration of supply, as sellers come in and take profits. As a swing trader, you can use these levels to your advantage. A simple strategy is to buy near a strong support level in an uptrend and sell or short near a resistance level in a downtrend. How do you find these levels? Look at a price chart and identify areas where the price has reversed multiple times in the past. The more times a level has been tested and held, the stronger it is. You can draw horizontal lines on your chart to mark these key areas. Trading the bounces off these levels is a fundamental swing trading tactic. Now, let's talk about what happens when these levels don't hold. This brings us to our third strategy, the breakout and breakdown strategy. A breakout occurs when a stock's price moves above a resistance level, usually with a significant increase in volume. This signals that the buyers have overpowered the sellers, and the price could be headed for a new, higher trading range. A breakdown is the opposite. The price falls below a support level, indicating that sellers are in control. To trade a breakout, you would look to enter a long position as soon as the price closes decisively above the resistance level. For a breakdown, you'd enter a short position. The key here is to look for confirmation. A surge in trading volume on the breakout or breakdown candle is a strong sign that the move is legitimate and not just a false out. False outs can be traps, so waiting for a candle to close above resistance or below support is a good way to filter out some of that noise. Always remember to set your stop loss just below the former resistance level for a breakout, or just above the former support level for a breakdown, to protect your capital. Next up, strategy number 4, using chart patterns. The market often moves in predictable, repetitive patterns that can give you clues about its next move. Learning to recognize these patterns is like learning a new language, the language of the charts. For swing traders, some of the most powerful patterns are flags, pennants, triangles, and head and shoulders. Let's take a bull flag for example. This pattern appears during a strong uptrend. You'll see a sharp price increase, that's the flag bull, followed by a slight, downward sloping consolidation period that looks like a flag. This consolidation is just the market taking a breather before continuing its upward move. The strategy here is to buy when the price breaks out of the top of the flag pattern, with the expectation that the trend will resume. There are many patterns to learn, but starting with a few simple ones like flags and triangles can dramatically improve your ability to time your entries and exits. Our fifth and final strategy for today is using momentum indicators. While price action is king, indicators can help confirm what you are seeing and measure the strength of a trend. One of the most popular momentum indicators for swing trading is the Relative Strength Index, or RSI. The RSI oscillates between 0 and 100 and helps you identify overbought and oversold conditions. A reading above 70 typically suggests a stock is overbought and may be due for a pullback, while a reading below 30 suggests it's oversold and could be poised for a bounce. Now, you shouldn't just blindly sell when RSI hits 70 or buy when it hits 30. A much more powerful way to use RSI is to look for divergences. A bullish divergence occurs when the stock price makes a new low, but the RSI makes a higher low. This suggests that the downward momentum is weakening and a reversal to the upside might be coming. A bearish divergence is the opposite. The price makes a new high, but the RSI makes a lower high, signaling weakening upward momentum. Combining these indicator signals with the price action strategies we've discussed, like support and resistance, can create a very powerful trading system. So there you have it, 5 powerful swing trading strategies perfect for beginners. We've covered trading with the trend, using support and resistance, playing breakouts, recognizing chart patterns, and leveraging momentum indicators. Remember, the key to success isn't to master all of them overnight. Pick 1 or 2 that make sense to you, study them, and practice them in a demo account before risking real money. Trading is a marathon, not a sprint. The most important thing is to build a solid foundation. Manage your risk with stop losses on every single trade, and continuously learn and adapt. I hope you found this guide helpful and that it gives you a clear starting point for your swing trading journey. If you got value from this video, please hit that like button, it really helps the channel grow. And if you haven't already, make sure to subscribe and turn on notifications so you don't miss our future videos. Do you have a favorite swing trading strategy? Let me know in the comments below. Thanks for watching, and I'll see you in the next one.